Hello and welcome to the next Trades and Tutorials video. This is Jeff Bish, president of MarketGauge.com, and in today's video we are going to take a look at gold and industry group rotation and how you can profit from it in a way that's different than the way most traders are looking at the markets. So the reason I'm focusing on gold today is because if you were watching the markets today, then you probably know that gold, and if we look at gold as displayed by the ETF of gold, GLD, was down huge today. And this is something that's been in a massive uptrend since the beginning of the year. Now, more specifically, we're going to look at it in terms of its industry group, the gold miners, but you can see that was down big today as well. However, if you remember the screen from the beginning of this video, we're going to look at it in a completely different perspective. But before we do, I want to make sure that if you are just finding us on YouTube, please subscribe and like this video to make sure that you get to these videos as soon as they come out. Also, I want to make sure you understand that we have more videos just like this at marketgauge.com/tutorials, and you can find even more information if you follow us on Twitter at MarketGauge or at Market Minute. And finally, if you're seeing this on Facebook, please also like us and make sure that you're watching this in HD using the little gear icon in the lower right hand corner. All right, so as I just showed you, the gold chart today in a normal candlestick view is pretty ugly. Gold gap down, that brought GDX down, and this really highlights a really important investment approach, which is to look at industry group and sector rotations. And if you're familiar with MarketGauge at all, you may know that we have a page which is free on our site in the blog area. In fact, if you go to the little big view area, our free blog tools, little big view, and then sector summary, you'll see this page right here. And on this page, we track 12 or 14 major sectors. It's not all of them, but it's enough to give you a sense of industry group rotation. And we look at them in a number of different ways. Phases looks at 50 and 200-day patterns, and then different time frames. And one of the most critical time frames that we watch is the 6-month time frame. All right, now in this video, I won't get into the details about the 6-month time frame, but there's a good chance that there will be a free report linked to this page where you can read a little bit more about that 6-month time frame. So here's the 6-month time frame, and we think it's so important actually that we track it not only in a column here, but we also track it down below in this chart, and the chart down below keeps a running tally of how many of the sectors in that table above are bullish or positive over the last 6 months versus bearish. So if it's bullish, you're going to get, it's going to add 1 to this indicator here. So if all 14 are positive, you'd have a reading of 14, and if, let's say, only 8 were positive, you'd have a reading of 8. Now we'll come back to this chart in a minute, because the reason that this is important at all from a trading point of view or trying to make money in the markets is because industry group rotation is an incredibly powerful way to make money if you know how to harness it. And this chart here was just going to give you a taste of how powerful it is. So let's just start with the gold story. Today, gold was down big, as I've said, and GDX followed it down. Now, I have taken all of the 14 ETFs that we saw on that chart, and I've put them on this chart. And then GDX is not part of the 14 that we watch. Then I put GDX in red. Now, the S&Ps is this big black line. And this chart type is a percent change chart. So I've started this percent change chart just to give you some perspective. At the top of the S&Ps, the high in the S&Ps in 2007. Now this is a weekly chart, so it's a broad view. But the point I want you to see is that over this time frame, we all know what happened in 2008, 2007, 8, and 9. The SPYs had a horrendous year. And GDX, actually, when the market started to go down, started up. But let's not just focus on GDX. What I want to focus your attention on is that at all points in this chart, you've got the SPYs pretty much sitting in the middle of a mess. The mess is how the performance of all of these ETFs has done on a percentage basis since the starting point. And I'm going to show you how this works at multiple different starting points. So while today the markets are going to be focused on the fact that GDX had a bad day and it's rolling over, look at where GDX is relative to, say, the SPYs since 2007, way down here. And there are other sectors, which we'll get to shortly, which are way up here. So one of the key themes, key takeaways from this video is that if you're only watching what the S&P is doing, you're missing huge opportunities because the differential between the strongest industry groups and the weakest industry groups over multiple different time frames is huge. And if you can capture which industry groups are going to lead over specific time frames, you can dramatically outperform the performance of the S&P. So I think gold really illustrates this point when we think about what gold has done or GDX has done this year alone. Before I show you how it's done since 2016 in a slightly different perspective, you can see that since, well, let's call it about the middle of 2011, it has been in a severe downtrend, or was in a severe downtrend relative to most of the other industry groups. Right? Then in 2016, it did a complete reverse and had a beautiful run up. So let's just take a look at what that looks like from the perspective of just looking at 2016. So here is the beginning of 2016. So if we started our percent change chart in January of 2016, in other words, let's say you bought GDX January 1st and you bought the S&P on January 1st, well, you can see that in GDX you've had an amazing run that got as high as up 120%. Yeah, it's down big today, but that puts it down at 70%. And meanwhile, the SPYs on the year are trading up about 5 and change percent. All right, now GDX isn't the only industry group that's done pretty well this year. In fact, you've got the semis here, SMH, up 28% since January. And if we take a look at this same perspective, but instead of looking at it just from the random calendar year of the beginning of January, and instead look at this turning point at the bottom near February of 2016, you'll see that the moves relative to GDX are even more substantial. Let's take a look at it here. All right, so in this case, we start to look at the performance. If we had looked at what's performed since the bottom in 2016 of February, you can see that SMH here has had an amazing run this year. All right, much better than the SPYs, and now, and even for the last month, has been outperforming the much acclaimed gold bull market of 2016. Right? And you've got another group right here that's up 26% for the year, and that group is XLE, all right, energy. Now, if you take a look at the best performing group, up 48%, and the worst performing group, up 4%, you've got what is pretty normal over a 12-month period, which is about a 50% spread. And SPYs, or S&P 500, usually sits somewhere in and around the middle, but not always necessarily in the middle. So if you can figure out how to be in the groups that are trending, you're much more likely to outperform the S&P as long as you can avoid the ones that are trending down. Right, now let's just take a quick look again at a longer term perspective, and let's just take a look at starting from 2009, the bottom of 2009. And so in this case, you can see if you had bought gold, I kept gold as the big red one. That'll be a common theme throughout this. If you bought gold at the bottom of the market, you're actually down 28% from 2009. The SPYs, if you bought them at the lows, you're up about 200%. But if you had gotten into, say, XRT retail, you're up closer to 369%, right? At the peak, XRT was up 450%, right? And the other pattern to keep in mind here, or pay attention to, is let's just take a look at XRT. Notice how XRT, once this thing was in a substantial trend, it continued to trend. Now, not every single market will do that. And these trends don't usually last this long, and when they go into downtrends in here, you want to make sure that you are not in them there. So industry groups, let's take a look at another time frame. Industry groups tend to travel in a very directional way for a substantial amount of time and then correct, just like gold in 2016. That was its year after years of underperforming. If we look at, the reason I have this chart up is this represents when the markets, the S&P, took out its 2000 high, right? So 2000 peaked here, and finally in about February, March of 2013, it took out its high. So if you take a look at which industry groups performed the best after it took out that high, you'll wind up with a different set of groups. Now, in this case, SMH turns out to be the winner because it's had such a strong year this year. But had we looked at the same thing in the beginning of this year, SMH wouldn't have been the winner. And maybe you remember the big biotech rally. Now, we don't have IBBs or one of the more volatile ETFs related to biotechs in this index, but the XLV, the healthcare index, had an amazing run from 2013 to about the middle of 2015, up close to 70% at a point where the S&Ps were up less than 40%. So again, if you knew that the healthcare or biotech was the right place to be in when it was outperforming, right? So XRT is nowhere on this chart in terms of the leaders because during this time frame, that wasn't its strongest trending period. So meanwhile, you've got biotech or healthcare up here at the top, and at the same time, you've got energy down here at the bottom, actually down. So again, the key is you've got XLE, for example, down 10% at the same time, and that's over about 2 years. At the same time, you've got the strongest group up about 72%. Right? That's an 80 percentage point spread, and the SPYs sit right in the middle. So I think you should be able to see, based on what I've just shown you, why we feel it's so important to be able to tell which industry groups are leading and keep track of whether or not they're leading on not just a 5-day basis or a 1 or 2 day good day, but look for the longer periods. Use the 3-month to see if they're starting to move. Use the 6-month as a solid foundation, and a year to date to give you a sense of how long that trend has persisted. And you'll see that many times these trends persist with big numbers right across the board. All right, now, to further evidence the fact that industry group strength is a key component to knowing what the market's going to do. If you take a look at the charts at the bottom of this page, you'll see that when we add up these number of industry groups that are positive, when you have a high number of these groups positive, when the market pulls back even under the 50-day moving average, it tends to be supported. And if it moves back over the 50-day moving average, those are the retracements that you want to focus on to buy. Now, let me take a look, or I'll show you these same charts in a more active chart. So let's take a look at the history. Same basic chart, I was just showing, this is summing up 14 industry groups, so this number would be 14. And in this case, I put a line at about 7. Now, this isn't really a magic number of 7. 3 is an important number to us relative to the 200-day moving average, and here's the 200-day moving average right here. But if we look instead at 7, or at the trend of the industry groups that are positive, as the markets get below the 50-day moving average, it's an important metric. This is important right now, and I bring it to your attention right now because if we look at where the SPYs sit, the SPYs took a long time to break out of all the consolidation they put in from 2015 through most of 2016. Now they've broken out up to new highs. This is another one of those inflection points that someday we're going to look back on and say when the market broke out from these highs, which industry groups were the leaders and which ones were the laggards. But before we get there, the other thing we want to know is whether or not when it pulls back to this breakout level and sits under the 50-day moving average, how we should treat it. Well, one of the things you should be watching closely is how well these industry group summations hold up. All right. So if the SPYs break back over the 50-day moving average and the industry group numbers maintain and move higher, then you've got a situation like we had for a very long time in a strongly trending market where every time we came down and the market looked terrible, the industry group readings here told you that there was a lot of support down near the bottom, or there was a lot of support underneath that market. So keep an eye on these being up in the upper range towards 10, 12, when we pull back under the 50. When we get down to the 200, you really don't want to be long under the 200. And if you don't want to be you don't want to be long under the 200, and you have to be especially careful if the industry groups number of industry groups drop below the yellow line, which is 3. So more specifically, as this market sits under the 50-day moving average, if you see these lines kind of fall off a cliff, kind of like they did in here, right? They went from up here, kind of fell off a cliff, leveled off here, but the market wasn't making any progress, and then it broke and it completely fell off a cliff, right? It took a long time for this whole digestion, this weakness to recover. Once it recovered, with the exception of Brexit, it's really been a strong market. But now it's beginning to be questionable. I'm not going to call it weak yet. If the market turns up and goes over the 50-day moving average, all could look really, really good. But it wouldn't take too much for this to really fall out of bed, and that would be problematic. Now, getting back to how you identify the best sectors to be in, well, there's a couple of ways you can do it. And as I said, I think there could be a free report on using ETFs and sectors as an indicator. Make sure you check that out if there's a link in this text. And there also may be a link to an upcoming webinar where we'll show you how we've developed systems to be able to use the differential between the strongest industry groups versus where the SPY sits versus the weakest industry groups to dramatically outperform the market. I hope you can find the report. I hope you can attend the training. Even if you can't, all the information you just showed you on the website is free. Make sure you check it out and keep an eye on what industry groups are doing. They're incredibly powerful in telling you what the market's going to do next.